I was spending like 20 hours a week studying this stuff, going into Excel spreadsheets, looking at every single loan that had ever been originated and looking at its performance, and really felt like this is a place that I could get serious about. And then I was looking for something to do after I'd sold my company. I took a couple of years off when I just started off as an investor and thought, well, hang on, no one's really focusing on this space and people should shout this from the rooftops. And so started blogging about it, and the rest is history. I started just kind of building a community, and that just led into an event and really just became kind of obsessed with peer-to-peer lending.
Welcome to the Operate podcast, where we give you a behind-the-scenes look at company building from the perspective of the builders themselves. This is how we operate.
Welcome to the Operate podcast. I'm Peter Renton. Today's episode is sponsored by Fintech Ventures, the first strategic investment fund designed by the community banking industry for community bank innovation and investment. Fintech identifies leading products and technologies for community banks and works with the founders and management teams to maximize their impact on community banks and their businesses. If you're a bank looking to innovate and invest in the future, or a founder who wants to work with community banks, reach out to Fintech Ventures at banktechventures.com. So today my guest is my friend Peter Renton. He has a super long history in financial services and fintech, and to many, I would say they would consider him one of the fintech OGs. So it's exciting to have him here. There's a little bit more background on Peter if you don't know him. He founded Lend Academy back in 2010. He also co-founded a company that some of us know called NSR Invest, which was one of the earliest investors and advisors in P2P lending. And he co-founded a very popular content and event company called LendIt back in 2013, so over 10 years ago. Eventually became Fintech Nexus. We'll talk about that today. And he has, I think, the longest running interview podcast in the fintech industry, and I think is rapidly approaching episode number 500. Peter's advised a whole bunch of well-known fintechs, and he still works with a number of them as well. I appreciate the fact we now have known each other for over a decade and always enjoy our conversations, his perspectives. And we finally get to record a conversation where you're on the other side of the microphone, Peter. Thank you so much for joining.
Well, thank you, Kerry. It's always great to chat with you, and thanks for inviting me on the show.
Absolutely. Well, let's start with personal background. What in the world attracted you to actually get so fully embedded in the financial services industry?
Well, it's funny. My father was an entrepreneur, and he was a self-directed investor. And I've always been interested in finance and investing. I basically started investing my own money back in the late 70s when interest rates were at like 18%. As a kid, I just thought, this is fantastic. I'm getting like $10 interest a month. It's amazing. And so I've really always been a self-directed investor. I probably should have done finance in college, but I was convinced to do computer science, which I spent like 2 years in that industry and then left. But I've just always had a fascination with finance.
Interesting. Well, we'll talk a little bit about some of those early entrepreneurial endeavors of yours as well. But along those lines, I mean, it's interesting, the interest rates, obviously you talked about way back in the 70s and 80s when they were at peak, particularly compared to even today. But P2P loans, when they really first came out, were an interesting investor opportunity. Yep. So how did you come upon that? Was it that background, or what was it?
Yeah, so it came up. I just sold my second company. I sold my second company July of 2008. It was in the printing industry, nothing to do with finance at all. And interest rates went to zero. And luckily, I kept all that money in cash for several months, which was a fortuitous thing.
Sure.
And suddenly interest rates went to zero. And I thought, well, I really want to put a lot of this money into fixed income. And I don't want to earn zero. So I started looking for different alternatives. And I came across peer-to-peer lending in a magazine article. It was Money Magazine back in this was late 08, I think, maybe in early 09. And I just started doing some research and opened up a lending club account, then opened up a Prosper account, invested my own money, and just loved it. I thought, this is fantastic. I was getting, back in those days, you could get 10, 12, even for 14% I got in my first year at Prosper. And it almost felt too good to be true. But at the same time, I was spending like 20 hours a week studying this stuff, going into Excel spreadsheets, looking at every single loan that had ever been originated and looking at its performance, and really felt like this is a place that I could get serious about. And then I was looking for also for something to do after I'd sold my company. I took a couple of years off, and when I just started off as an investor and thought, well, hang on, no one's really focusing on this space, and this should be, people should shout this from the rooftops. And so started blogging about it, and the rest is history. I started just kind of building a community, and that kind of, it just led into an event and really just became kind of obsessed with peer-to-peer lending.
So cool. Well, and I think, the highlight there of, at a time when, normal alternatives in a fixed income world were close to zero. I love how you highlight it. Almost felt too good to be true. But next best alternatives are such a powerful thing when it comes to investing. And obviously this was an incredible alternative to other options.
Yep. It was a great alternative, I think, for investors and also for borrowers, because if you remember that time, we had personal loans were not really a thing. Certainly the ones that had personal loans during the financial crisis just stopped doing it. So there was very, very few options. So it was a great thing for the borrower. It was a great thing for the investor. And I thought it was going to completely reshape the financial system, and peer-to-peer lending was going to be this trillion-dollar industry. Didn't quite work out that way, but it was something that I think it certainly changed the industry forever.
Absolutely. And I definitely want to talk more about those changes that you feel like have happened as a result of that. So you mentioned, you started blogging, and ultimately LendIt started there. From the blog, any interesting people that you recall in those early days, as well as even, early highlights from some of those first events that came a couple years later?
Sure. Well, I first met Ron Suber, who was really one of the fintech OGs as well. People call him the godfather of fintech for many years, because he basically helped architect the deal for Prosper in like January of 2013. And I'd met him because he used to comment on my blog, and we would have email exchanges and phone calls sometimes. His interest in peer-to-peer lending was like mine. He had personal money invested like me, and really we would just talk about the industry and different investment criteria and what have you. And then that sort of, he was very supportive of starting an event. What happened is I had this community of about 3,000 people who would come read my stuff on my mailing list, and they said, you should start a conference. And it kept on coming up again and again and again. And I thought, by like the 7th or 8th time, I said, okay, I'm going to figure out sometime in 2013, I decided that's the year I'm going to start a conference. And so, and at the same time, someone else had a similar idea, my co-founders, and we got together and we put on the first LendIt show, June of 2013. And Ron Suber was one of our keynote speakers. Our opening keynote was Renaud Laplanche, who was CEO of Lending Club. These are gentlemen I got to know as I was really the only person writing every single day about peer-to-peer lending. So I got to know the leaders in the industry, and that parlayed that into sort of building a successful conference.
And there's so much instructive in that, even for other entrepreneurs, right? I mean, you've seen over the last 10, 12 years, scenarios where an entrepreneur that's kind of in a super early new category, using community, using even events as a way to coalesce that community. And in your case, really bringing this marketplace together. It's fascinating in some respects that it eventually became called marketplace lending and not just P2P, because it was a marketplace that was being created. And I think that also reflected that evolution where hedge funds and other more professional investors started to come in from the capital side. By the time I started to get involved in 2013, we were definitely seeing a lot more of that than the traditional P2P. And we sort of jumped away from P2P when we started Payoff, and I think had some thoughts that maybe eventually we'd go back to it and use our borrowers as the future investors as a way to kind of close that total loop. But it was a fascinating time for sure.
It really was. And I think that's when I first got in, it was pure peer-to-peer. There were no institutional investors. I mean, there was some, high net worth individuals that were putting, 6-7 figures to work, but there was no companies putting money to work. And that started to change. And I watched that unfold really interestingly, and just would see that back in those days, the companies would post, basically do their volumes every month. They would share how much what their total loan volumes was. And we're talking like 6, 8. I remember when it got to 10 million a month, I was going, woohoo, that's amazing. And it was all mostly done by individuals. And then we started to see the likes of Cultus, I think, was the first really big fund that came into the space, and soon there was several. And I remember when Cultus announced they were putting $150 million in, that was just a monstrously high number. I think it might have been 2011 when that happened, and that was when we realized that okay, it's no longer peer to peer. If a company is putting in 150 million, it's really. And that's where the term marketplace lending evolved from, because that just didn't make any sense when you've got hedge funds coming in.
Yes. Any thoughts on why we haven't seen more kind of P2P in other categories?
Yeah, it's a hard business to scale. Like that's the thing that you look at the UK, where P2P lending actually started with the launch of Zopa in the UK. And, you had Zopa, you had Funding Circle, you had RateSetter, all of them closed down their peer-to-peer platforms. It's just, when you like, let me just go to the other example of Culture's put in $150 million. That was a big deal. And if you look at all the individual investors and the effort and the expense it would take to bring in that amount of money onto your platform, and how long that would take, and the expense of getting those investors in. I mean, it just made it so that it's a hard business to scale. If you want to have a small lending business, almost like a lifestyle business, you could create a peer-to-peer lending business. You can do your $8-10 million a month, and you can make money out of that as long as you've got a pipeline of borrowers. But if you want to scale it into the big leagues, there's just been no one outside of China where they were able to scale, but then there was all this fraud happened and they had to shut down the whole industry basically. But you look around the world, peer-to-peer, there's a lot of companies in Europe. There's some companies in the UK, and obviously we still have some here that are pure peer-to-peer, or most of them have some institutional capital. And you look at them, and there's nothing at like multi-billion-dollar scale that has done pure peer-to-peer.
Yeah, it's a fascinating topic, because you feel like with all the movement we've seen in technology, infrastructure, blockchain, and just easier valuation and trading and other technologies, that the potential for it to do that and scale it seems like it should be there, but you just have to find those aggregation points, whether it's retail brokerage platforms or financial advisory or something. I think would have to be the gateway, because I remember with the early Lending Club and Prosper, and they were their own full stack solutions, from the web experience to all the underlying trading and pricing technologies. And you probably would have to do it with a lot of other partners today, I would suppose.
Yeah. And it's why you haven't seen, although I did talk to a platform just earlier this week that is in the solar space, that is really trying to make a go of peer-to-peer for solar. And they're still pretty early days, but not a model that is dead. But for every one of those, there's probably 25 companies that are not considering peer-to-peer, because it's a hard thing to scale.
Yeah, for sure. And I mean, I feel like every lending founder I've met in the last 7-8 years is all looking for first dollar institutional money, right? They're just trying to jump straight to some of the funds that we know that can be these early lines for them to.
Because you look at that, the infrastructure that's been built for lending companies. I mean, that like, if peer-to-peer was really great and something that everyone was going to be doing, which is what I thought would happen when I first got into it, then there'd be all this fintech infrastructure that companies, like Unit, like all sorts of other, places, companies that, like Nova Credit, we were talking about before we started recording, that these companies provide infrastructure to lenders, but there's no one providing the peer-to-peer infrastructure because there's just no demand for it. And if it was sustainable, then we would have 3 or 4 companies in the peer-to-peer infrastructure space providing it for all these for lenders, but it doesn't exist because there's just not a market there.
Yeah, that's right. And I think even crowdfunding on the equity side, which has some corollary elements to it, has been generally pretty subscale.
Yeah, exactly. I mean, there's a lot of enthusiasts in the crowdfunding space on the equity side. I think it suffers from similar challenges to the lending side, and one could argue it's more difficult than the lending side because, picking equity winners is a lot harder than picking lending winners, shall we say?
I think you are right, my friend. So you started LendIt, the conference, and maybe you had some early people even in your community online, but at what point did you start to see banks actually showing up at your events?
It's interesting because at our 2013 event, the very, very first one, we had 2 community banks that had just announced that they were investing in Lending Club loans. And so both of those companies were there. I think there was a smattering of some of the New York banks. There was probably 3 or 4 of those that came as well, just as a curiosity more than anything. It wasn't really until like 2016, I think, we started to see banks in significant numbers. We probably had at least 50 banks by then that were attending. It might have even been close to 75 or more that were doing it. And then towards the latter stages, remember our 2019 event, banks were one of our fastest growing segments, and it was over 800 attendees who were from banks. And I think it was like 180, 190 banks of that were coming. So clearly banks became very much a part of the story fairly quickly. But 2013, 2014, and even in 2015, there was only the enthusiasts, the ones that had decided that this is something that we want to really be a part of. And they were relatively small in number.
Yeah, it was. I was amazed in those early years, like even 2013, 14, when we were out trying to find banks. That they just didn't understand it. And most of them would say things that you almost intimated this earlier, like, we don't do unsecured personal lending here. So why in the world would we have interest in these assets?
It's a great asset class. Come on.
It was a great asset class. I agree. It was fascinating. So as you think back though, it was the post-financial crisis, there was a need for these products, as you were saying. Do you feel like it got, like a lot of venture categories, do you feel like this particular area of consumer lending or fintech lending got overbuilt? Do you think we saw too many companies doing the same thing, and that was, that partly led to this overinvestment in 2021 in fintech? Or how do you sort of think about that decade between 2011 and 2021?
Yes. So, 2011 was obviously the really early days in the fintech lending space, but there were companies like OnDeck and Cabbage that were out there on the business side. And, you had Lending Club and Prosper, and there was a few others that were getting started. And really I remember our 2015 event, where we felt like, oh my goodness, this is like a lending bubble. Anyone with an idea for a lending company was getting interviews with top tier VCs and all of the credit funds that were out there, and people were just throwing money around. And we saw companies that ended up folding in a couple of years, but they were getting $100 million checks on the debt side and, $25+ million on the equity side. And it was, so we thought like there was this mini bubble. Like fintech had the bubble in 2021, early 22. The lending space had that bubble earlier. And then started like in early 2016, it was starting to deflate a little. And then we had the Lending Club debacle of May of 2016, which the Lending Club CEO was forced to resign. And that was a massive black eye on the industry. And suddenly all the lenders went from being flush with money to everyone pulling back, except the individual investors. They stayed. But all of the banks, every single bank, I think 100% pulled back, at least temporarily, and many of the hedge funds as well. And it was a scary time. It was a horrible time, but that kind of reset the industry. And a lot of companies, a lot of the lenders didn't make it out of that, but the ones that did were stronger and obviously had a track record and had the wherewithal to kind of bring these investors back. Because the asset class didn't change in May of 2016. Right. It's just the appetite change.
It was just, and like the underlying dynamics and infrastructure. I remember just, you think back to the number of people that were sending direct mail to consumer households. I mean, it was a potpourri
I'd get one of the fintech lenders every day. I'd get one of them every single day in my, because I was, and I felt like that was, and you talk to the lenders, and I would talk to the marketing people and say, we're doing direct mail because it works. The customer acquisition cost is low compared to doing a Google ad. So we're doing direct mail.
So as you think back on that period and you're advising founders today, how do you think about that as just guiding them and paying attention to either competition or overcrowding or industry dynamics like that?
Yeah, well, I think the number one lesson is you need diversification of your customer base, whether that's the people. If you're a lender, then you need to have major diversification in not just the number of lenders, but the different types of lenders. You want to have some family office capital. If you've got some credit funds, they're good, but they're really they're quick to move. And you like, if you can get endowments, insurance companies, the different types of investors, that's the really important piece. Because if something happens that the one group suddenly says, oh, we're out, we don't want to do this anymore, you've got to have others in place. And obviously the one thing that, as an individual investor, and I still remain to this day, I still have my Prosper account. Lending Club shut down their Peter Renton platform, but I still have a Prosper account that I opened in 2010. And that's
Amazing.
still running. And you talk to the guys at Prosper, and they love their peer-to-peer lending platform because it's sticky. It's the most sticky capital that they have. Because for me, I don't log on to Prosper. I have an automated investment thing, and I just, even during the crisis of 16, during the pandemic crisis, I just kept that going. I just kept it going, and so did a lot of people. So that was a really good, stable source of capital. And so that, and then the other piece is that, customer acquisition cost. You've got to have, back in the heady days of 2015, everyone was doing direct mail, but it was working for just about everybody. And people were acquiring customers at a rate that made sense economically, but that didn't last. And I think we saw an oversaturation of, when you're getting when someone is getting an offering in the mail every day. It was like the credit card offers.
That's right.
In like the early 2000s, there was so many of those flying around, and suddenly the lenders. But you need to just not rely on one marketing channel. That's the other piece of advice I think is really important.
Yeah, I think that's a great point. And sort of, I think the other, probably I would say, is anticipate that if it's working, people will realize it and likely copy you.
Yep.
I mean, you feel like the rate of copy in the market today is so high. And I
It
see that
is. It
in
is.
the
And
startups.
that's what
Yeah.
happens. I mean, I remember in my old company, I had a label printing company. I was the first label printer on Google AdWords in the country. And I was like, got really great search terms for 20 cents or 15 cents.
Yeah.
And
You didn't have to be that good. You could just,
I was like printing money. That was how we built our business. And
sure.
And then by the time we sold our business, we were the fastest growing printer in the country when we sold our business. It was very competitive. But
Sure.
so you make hay while you can. And I remember that time just trying to put adding new shifts, buying new equipment, doing everything to try and grow the company, because I didn't feel like we were going to have this advantage forever.
Sure.
But you can make hay while the sun shines, and then plan for the competition.
That's right. Well, last question from sort of this section. What company were you surprised of all the ones that you met along the way that really became a really big company that you were sort of surprised by?
Okay, he's probably going to be really annoyed with me for saying this, but I'm going to say UpStart.
Okay.
Because UpStart began their life as an income share agreement company.
Yes, I remember that.
They started that, and there was another company called Pave that was competing directly with UpStart on income share agreements. And of course, now we don't really hear much about income share agreements. They're not really a popular product, but they pivoted, and in pretty early, I think it was like 2014. It was within a year, but at the time I'm thinking, oh my God, they're pivoting into a lending space that's fairly crowded, and they're late to the game, and they've got this sort of knock against them that they tried something and it didn't work. Are companies going to really trust them? And they had the AI. They were the first ones talking about AI. That's really what kind of, I think, gave them the wherewithal to basically help them become a success today. But in the early days,
and it was also a problem for them for a bit too, because the skepticism around that.
Well, I remember having arguments with the marketing people at UpStart because they wanted their CEO on our keynote stage, and it was one of those things where I was a little hesitant. We ended up putting him on, but it was a lot of convincing, because I was skeptical even several years later that they were going to be one of the top tier players. But kudos to Dave Girard and the team over there. They've done a phenomenal job. I mean, obviously they're a public company now. You can see what their valuation is every single day. They've had some ups and downs, shall we say, but they're still going strong, and I think kudos to them.
And I mean, multi-billion-dollar company, right? Yeah. So it's hard to be too critical of that. That's a resounding success.
They're not where they, I think it was their high point was at 21, like it was something like October 21 or thereabouts, where they were worth an astronomical amount. Like it was not in the single billions, it was in the tens of billions, I believe.
Amazing. Well, thank you for that. So you then moved from LendIt, pivoted, or sort of expanded the aperture, I'll say, of what you guys were doing, and renamed as Fintech Nexus. So what led you guys to that decision?
Well, it started off, it really was SoFi that began the journey for us, because SoFi, one of our top sponsors. In fact, we're proud to this day that the biggest marketing check that SoFi had spent by June of 2013 was with our event. That was their biggest marketing check they ever spent. And they continued to be a big supporter of ours. And then in 2016, they said, oh yeah, we're moving into outside of lending into other areas. We're not going to sponsor this year at all. And so we went, hang on, that's a problem. And then we were looking at other companies. A company like Moneyline was also expanding into other areas. We thought, well, if this is the trend, we don't want to be, we don't want to be left behind. So obviously we started in 2017, our 2017 event, in response to what SoFi really did. We said, okay, let's bring in other areas of fintech. We started with like some wealth management, some digital banking, and lo and behold, to us, we thought we'd be 10 people in the rooms of some of those sessions, but they were packed. And because clearly others in the lending space, and we were pure lending. And so the 2013 through 2016, there was only lending content. And we had a lot of content that we would, talking 400 plus speakers, multiple tracks. And and really covering everything you can think of, but all lending. Now we threw up some other content, and it was popular. And then, so that started the journey. And then we kept on adding more of the non-lending content. But even 2023, when we changed our name to Fintech Nexus, it was, if you looked at our agenda, still, slightly over half was still lending related content. Mm-hmm. So we still considered ourselves the largest lending event, but we wanted to be, not just, we didn't want to kind of be kind of forced into just the lending lane when a lot of companies were doing more things. I mean, you had Lending Club, obviously buying a bank, taking deposits, and still have their lending business, but they've got lots of other things that they're focused on now as well. Another company that was a supporter of ours for many, many years, all the way through, actually, and so that sort of validated our thesis. And so when we started to really bring all these fintech companies together that weren't anything to do with lending, we thought we can't just call ourselves LendIt anymore if we're trying to really bring non-lending companies in. So that's why we changed our name.
Yeah, it makes complete sense. And frankly, we've sort of seen that movie before. If you think back to Capital One, that was a monoline credit card company that eventually became what it is today, and a very diversified financial services. And I felt that sense as one of those relatively early consumer fintech lenders, that we needed to be more than just that to be as valuable as we could ultimately be. And that actually is part of what led me to go to another neobank that wanted to do that and lending, and sort of had a little bit more of that diversified product portfolio. And I feel like that's what SoFi has done particularly well out of several others.
Right. And now they have a massive stadium to their name. Their marketing budget's gone up a little bit.
That's right. Just a little bit. So, yes. So as you think about the next wave, right? I mean, you guys, made the decision to get out of the content and events business recently. I'm sure you don't think that banking and fintech is going to stop evolving. So as you think about this next wave, any thoughts on the horizon for you?
Well, yeah, I mean, I love the fintech business. The events business is, I also love, but it's an incredibly stressful business. It's something challenging to do year in, year out. And I didn't realize until after we sold the events business how stressful it really was, because I didn't have that stress of, you're always trying to, come up with new ideas. You got to bring people in the door. You've got to sell everything in advance. It's a business that, with the pandemic, when the pandemic showed us everything. It changed everything for us. We barely survived. We should not have survived the pandemic. We got incredibly creative and worked our asses off to kind of to save the business. And all of the money that we had accumulated up until that point was all out the door, because we had multiple millions of dollars as requests for refunds when we weren't able to put on our event. And so that was really a horrible thing to go through. And that kind of led to our, openness to selling. And, when Fintech Meetup, when we talk with them, that was, we couldn't say no to that kind of deal. And, I miss the events business in some ways, because I love being at the center of things. I love all of the excitement of the 2 days of the event, but all the stress leading up to it, I do not miss that at all. But as far as fintech goes, I feel like it's such an exciting time. The lending space has, I think, matured tremendously, and I think there's still innovation happening there. I'm really excited about sort of, the lending, because really when you let's take a step back and look at financial services overall. Sure. One of the biggest profit pools in all of financial services is lending. Every major bank does lending and makes a majority of their profit from lending. And that hasn't happened in fintech. A lot of the fintechs have, started off in payments, debit cards, checking accounts, but every single fintech, I believe, is going to get into lending. And
the ones that survive. I think
of course,
you're right.
Those that survive. And because it's a great business. It's a hard business. It's a hard business to do well, but it's obviously not impossible. Banks have been doing it well for centuries. So I think the move sort of towards embedded lending, where you don't have to create a program from scratch, I think that's a really interesting trend that is going to continue. But because I think every single vertical SaaS company, every single fintech company is going to have a lending arm because it just makes sense. And so but the embedded lenders are going to be the ones I think that will do really well there. I also think we haven't touched on this yet, but we've got to get our regulatory house in order. That the whole debacle around the Synapse kind of blow up has tarnished the industry I think a pretty profound way, and we've got to really get over that, and I think we will. But it is a black eye. I'm really bullish on mobile wallets. I think we're all going to be transacting in mobile wallets. I transact in my mobile wallet every day. I've got all my cards and everything I can get loaded into Apple. My Apple wallet is loaded in there. I think there's also new payments rails that are coming up that, Visa and MasterCard rails are going to be around for decades, but it doesn't mean that there won't be other payments rails that will achieve scale. I think we haven't seen exactly how that's going to play out yet, but obviously you've got the instant payments rails, you've got some of the blockchain things that are happening. I think really interesting things going on there. The thing about innovation is once it begins, it doesn't stop. We're never going to get to an endpoint. If we're talking in 20 years' time, Kerry, on a podcast about the future of fintech innovation, we're saying, well, it's been really good. There's so much more that we're going to do because innovation just doesn't stop.
That's right.
And
That's right.
It's going to become more and more interesting, I think.
Well, it's fun to be in it. I think the crazy thing, Peter, is when you see that fintech itself is such a small amount of the activity that actually is happening in lending, in payments, and so it's a very small market share so far. And so
I should do a shout out to my friends at QED and BCG. They just put out their second report. I was at their launch in New York when they did it last month, and it was, fintech is growing, but the even if we can 10x fintech from where we are today, and we'll still have a lot of growth opportunities.
That's right. And so I think that's the perspective that we have. I obviously work a lot with banks now. What's your view on banks in the traditional sense of a bank? Do you think they're going to continue to have a key role to play? They're going to have less of a role to play?
I think they're going to have a key role, but I've got a fairly some people would call it radical idea that we have way too many banks in this country. I know we've gone down from the high.
Sure. There were 30,000. We're at 4 now. Come on.
I know. I'm from a country where there's less than 100 banks.
Yeah.
It's small economy, but Australia has 4 big banks that control probably 80% of the market, and then a myriad of smaller banks. And so I think we're going to see consolidation in the banking space accelerate. There's, not every town does not need its own bank anymore. It used to, but and I think community banks, there's been consolidation already. Sure. And you've obviously seen small community banks being acquired by other small community banks to kind of broaden a geographic region. But in the world of digital, I think, the people of the consumers of today, you demand a digital solution. Funnily enough, I've been reading a lot of the Gen Zs actually do like to have someone to talk to face to face, or at least over a Zoom call. So there is, you can't take digital. There is going to be room for these brick and mortar banks, but I think I'll be shocked if in 20 years' time we have more than 1,000 banks in this country. I'll be shocked.
I think I probably agree with you on that number. I think the consolidation will continue. The thing that I think brought back how important those relationships are. And that's the real question is do those dramatically deteriorate at scale? But PPP was one of those scenarios where the community banks did so much so quickly for their small business communities and did massive amounts of volume relative to their market share.
Yeah, well, I'm obviously a fintech enthusiast,
sure,
right, and deep in the industry, and I got my PPP loan from my local community bank because I talked to him on the Saturday. The PPP launched on a Friday. I talked to him on Saturday, and I couldn't get a hold of him on Friday. But it was, we were able to do this over the weekend, and so our loan application was submitted to the SBA on a Sunday, and I did that because they had that personal service. Whereas I know, like, I could have gone to someone like Cross River Bank because I know the guys there, and I actually did talk to those guys over that weekend as well. But I didn't want to be a burden to them, which is, because I felt like everyone was just going, balls to the wall, just as much effort as you could possibly do. And the community banks, I mean, I knew my local community bank was, he was putting in like 50 PPP loans. He wasn't putting in 5,000. And so that was, and we were one of the first. So that was kind of where they excelled. And I think that there's a good argument to be had for, tech-enabled community banks. I don't know how many we need, but maintaining that personal relationship is their edge, because, a Chime or a SoFi, they can't do that. You can't have that personal relationship with millions of customers. But if you can manage to kind of maintain it with, you can do, I don't know what the upper limit is with new technology. That upper limit is going to keep shifting. And particularly if we start to add in AI, where, maybe the customers of tomorrow will be okay with talking, at least initially, with an AI bot. But and then talking to a human as sort of a second layer, that could end up really helping community banks as well.
That's right. Well, let's go one step deeper. So I write a column pretty regularly on the BankTech website called "If I Were a Community Bank CEO." So you get installed into one of these 4,000 community banks, Peter, with all the background you now have over the last decade plus in fintech and lending. How do you guide a team in a community bank to be one of those 1,000 that's still standing 10, 20 years from now?
It's a good question. And I think, I don't think community bank CEOs should be just totally focused on technology, and that's it, to the be and end all of other things. I think you've got to have good tech. If you don't care about technology, you are not going to make it. There's no question about that. But you don't have to have a tech as good as the leading fintech companies and the leading banks. You just got to have good tech. What I would do if I was those guys is, like, how are you getting the under 40 customer in the door? What do they want from you? I feel like, a lot of these community banks have an elderly, customer base, and, that's fine for now. But if you want to keep growing in 10, 20 years time, you're going to have to get younger people in the door. So I would want to know because obviously they're going to have some, I would imagine every community bank is going to have some younger people. What do they want? What's going to make them happy? I'd really be focusing on that cohort and developing products around not just the you want to develop them around not just sort of the Gen Zs who are just getting started into the workforce, but really the millennials that have money, that are looking to borrow money to buy a house or a car or whatever. What is it going to take to keep them in your orbit? I'd be really focused on that particular population.
Great advice, and thank you for playing along, at least for a moment. Well, final few minutes we have together, I want to talk a little bit more about you. It's interesting to me. You mentioned your computer science background. You mentioned your time buying early Google AdWords. I was in that world and used to laugh and say, when it's 10 cents a click, I don't actually have to be that good.
Right.
And you mentioned that. What sort of captivated you about the internet? And you mentioned you were doing blogging and digital marketing. Kind of the confluence of all that has been so pivotal in the last 30 years, 25, 30 years.
Right.
What is it about that really captivated you? Because there are people our age that didn't really delve into it to the depth we have. So I'm just curious kind of what drew you in.
Well, it's interesting, because I'm not like a natural salesperson. I am an extrovert, and I do like going to parties and going to big events and talking to lots of people. I get energy from that. But I'm not a great salesperson, but I love to write. And so how I built my other businesses was, before Google AdWords, I did direct mail. So I would write direct mail, and I would be constantly testing. Every single mail campaign had things that were testing. And the great thing about that world is that, while eventually got overtaken by the internet, you could test even easier with quicker results.
That's right.
You can test an email, and you can find out in an hour what email subject line works better, what email copy is working better. So I loved all of that, kind of the marketing side of so it was a blend of, I love to write, and I still write. I like to write to this day. I would even get in, until we hired a really top-notch marketing person. It was only back in like 2022. I would do a lot of the marketing myself, as far as either writing it myself, or more often I would be proofreading it myself. But it's a really important skill to have. I would say that every company today, if you don't have a good marketer, and if you're an entrepreneur, you start off usually with no marketing person, but you do it yourself. And I think being able to learn how to use email marketing, how to use Google AdWords, those are the sort of things that I just found endlessly fascinating. I would just be toying with this stuff and playing around with it, and seeing, particularly, it got to the stage where I could see, if I changed the wording of this ad, how many more orders did I get, and did that increase the average order size, and all those sorts of things. So it's something that, not everyone's fascinated by it, I realize, but if you want to be an entrepreneur these days, you've got to at least have some knowledge of email marketing, online marketing, search engine optimization, all that sort of stuff.
Yeah, and either how central or supportive it is to your business, because it's going to affect it, influence it in some way, no matter what.
Unless you're selling like airplanes or something that's massive, that is a really high ticket item. If you're selling software, you're selling relatively low ticket items, and even that, if you just want to fill your lead bucket for your salespeople, if you're selling, $1 million items, you've got to know how to bring those people in.
That's right. I am shocked how many people are still resistant to even that idea. No one's going to fill out a form on my website or download a white paper or whatever. And I go, people are doing this for multi-million-dollar. I mean, I've seen it in businesses. I always say to people,
just try it.
It's people like us, like we have big budgets to spend on things, and sometimes we'll indicate interest in something. And it's been such a humbling experience for me. I used to, when I would write a bunch of ads, I would always pick my winner, and I was wrong 100% of the time.
I have been humbled that way as well. And I would sometimes look at the winner and go, that isn't worded as well. It's uglier. And yet it's the numbers don't lie. This is a better promotion. And so that's the beautiful thing. You go with what works. You don't go with what you like.
That's right. Last question. You recently formed your new consulting business, Renton and Co. Tell me a little bit more about that, and who are the ideal clients that you would love to have?
Sure. So Renton and Co. is a new type of consulting firm focused on on fintech, looking at a lot of I'm broadly across fintech, but with expertise. Obviously, I know the events business really well, but I also I know the media business well. I know how to kind of get your word out. I have a podcast just like you do, Kerry, and that how to kind of use content in a way to drive people, to increase the visibility of your brand, to drive people to your website. And I also obviously know the fintech space broadly, and I do market analysis. I've already got a handful of clients, and I get new inbounds every day. With either it's a fintech platform. I've got a credit fund that's investing in lending companies. I've got some different small companies who just want help with like a small half-day event that they want to do. They want to make sure they're getting the most bang for their buck on that. It's any thought leadership. I like to write. I'm happy to help produce case studies over the years. Happy to kind of either write those things myself. I got a team of writers that I've worked with in the past, or just provide kind of ideas for content generation, all those sorts of things. I love this space. I love working, and I'm too young to retire, and I want to keep working in the fintech space for the foreseeable future.
Well, I know I can speak for a lot of people who would say we definitely want to keep you in and around this, and so appreciate the conversation and the friendship, and I knew we'd have a fun conversation, and thanks for hanging in with me today, Peter.
My pleasure, Kerry. It was always great to chat with you, and appreciate the good work you're doing here on your show.
Thanks. Talk soon.
Okay. See ya.
Thank you for listening to this week's episode of Operate Podcast. If you like this conversation, as a favor to me, you can rate us, review us, or subscribe, or tell your friends. You can also reach out to us on Twitter at Operate Podcast. Until next week, get out there and operate.